Before investing in stocks, investing can be as simple as or complicated as you make it. The most important thing when you are still a beginner is making sure that you have the bases covered. It is a it does take some time to prepare yourself for investing, but that will pay off down the line. The worst thing you can do is nothing. As the old saying goes, scared money doesn't make money. The lack of financial education present in the basic curriculum paired with the lived experience of people aged 23 to 38 has created a dire situation. More than half of millennials are not investing at all, whether it's a lack of fund, an overload of obligation, or just not knowing what to do. Young people are not buying stocks directly or through mutual funds, exchange traded funds, or treatment plans. The stock market is on a track to close a banner a year with a near record high, and the people would benefit the most from their growth over the time are investing. So in order to invest in stock market, what do you need to what do you need? A ton of cash, zero debit, or your MBA, but you need to know a few things. Know your history first. Let's begin at the beginning. That the stock market been around for more than 400 years. It is only 16th centuries like Britain and Holland needed a way to make their bank accounts larger to progress as industrialized countries. The power that be looked for companies that were doing well and made them to deal to trade them some money in exchange for a small part of their profits. To say that it went well in an understatement. So, as a result of the financial success, regular people wanted to be involved. This idea caught on, and Dutch companies began issuing shares on the piece of paper called stocks. People met in person to swap their paper stocks. Their meetings were the original stock exchange. In the development world, major stock markets emerged in 19th to 20th centuries. All of the world's major economy power have the highly developed stocks market that are still active today. Today, practically every country in the world has its own stock market. Now the upside. Since its inception in the US, the stock market has historically returned profit to its investors. Stock market returns to vary greatly from year to year and rarely fall into the average range. But with the being said, over the last 100 years, the stock market average return is about 10% before inflation is taken out into account. Sorry. In spite of being conflicted with the economy all the time, the stock market is not the economy. The stock market is driven by the emotions of investor, while the economy is created with the wealth and the resources in the term of the production and the consumption of the goods and services. They often do impact each other, but they are not the same. The strong economy with lots of growth can lead to the strong or bull market. When companies are doing well, a drop in the unemployment and will coincide with the rise in the corporate profit, and consumer spending will increase, therefore creating a strong economy. People are working, earning money, spending more, and saving more. On the other hand, more pacific or bear market indicate as a slowing economy with investor fear and pessimism. Well, we typically call it bear market when there's a 20% decline over a 2 year period in the market. know the downside. Uh, Economists are able to define the bull and the bear market cycle fairly predictably at this point based on the deluge of the data. But even they are wrong from the time to time. There are good evidence to show that the investor who try to predict high and low tends to earn much more return from those who just buy or hold.